This, of course, should have been a positive sign for investors, but this wasn't necessarily the case, according to Larry Shover, Chief Investment Officer at SFG Alternatives. He chatted to Kate Williams earlier and said that he was somewhat puzzled by the market reaction by Moody's.
I was shocked to see that, Spanish 10-year yields down 30 basis points on the day, at least in the U.S. And just the bigger story is, like, a week ago, everybody was afraid that the question wasn't if, but when. Now, the question is going to be, it's more when. When are they going to ask? Is it going to be January now? But it seems like the market doesn't care, because Holland came out this morning and said, hey, officially the euro crisis is over. And maybe that's not hyperbole. Maybe there's something to that. But it seems like the market just shrugged its shoulders. And you can see the periphery debt, all yields went lower. And U.S. Treasuries did just the opposite today.
Yeah, it seems like US markets don't care about Europe anymore. I mean, we used to see a real correlation between Spanish yields and S&P gains, but not anymore. Do you think investors believe that that tail risk has evaporated?
Yeah, I do. I do believe that what's driving this market is that the severe tail risk of Europe. Every headline that we were so worried about, even back in May, June, July, has evaporated, as you said, and nobody seems to care unless there's something that's going to change the narrative. But it seems like the tail risk has been removed. But coupled with that, U.S. and China numbers have stabilized, maybe not gotten a whole lot better, but they've stabilized. And there's also a whole lot of negativity in the U.S. equity market, and that's what helps driving us higher, at least in the U.S. stock market.
Yeah, you mentioned this negativity, and I can see in your note today you talk about the pain trade continuing. You believe sentiment there is too negative. I guess from our perspective, though, we've seen an incredible rally on Wall Street, something we haven't kept up with here in Australia. It's back at pre-GFC levels. It doesn't look that painful.
It is painful. I mean, keep in mind that I think this all started July 26th with the Bumblebee speech, and we've rallied, we've consolidated, that we've taken the next leg higher, and maybe Australia has not joined in our rally, but you're soon going to be doing that, especially when you see the Aussie dollar at 103, something nobody expected whatsoever. But our housing market seems to be bottoming out a little bit. Now, I know that's happening in New Zealand, not as much in Australia, but maybe you're lagging just a little bit, and you're going to enjoy the rally that we're seeing right around the corner.
So you think that the market over in the States is too negative. What then could be a catalyst for growth? What about earnings season?
Yeah, well, that's a good point, because when you take the S&P 500, right now, the top-down number is $105 U.S. The bottoms-up number is $115. So what that means is that there's $10 of reduction already baked into the market, and we saw that today. IBM missed on revenues. The stock was down 5.5% today. However, the stock market just shrugged it off and continued to rally, because we can absorb a negative shock because there's such a broad range of earnings estimations in the market right now.
So you don't see this as being potentially a disappointing earnings season? It sounds like it'll be potentially the most disappointing in 11.
Yeah, no, it could be very disappointing, but the fact is, like I said, there's $10 of variance built in. It seems like the market has completely written off Q3 and to some degree Q4, and they're more anxious to look at the fact that China's numbers have stabilized, and we'll see more of those tonight, some big numbers coming out tonight. And the U.S. numbers, especially today, our housing data came out far better than expected. So I think that's what people are focusing on. It's a lot more macro-focused and a lot less micro-focused. But if you don't mind, I do have to say, if that top-down number for the S&P 500 comes out below 105, that would be a narrative changer. But it's far too early to expect anything right now.
You mentioned the macro focus, and certainly on China. We in Australia are watching this GDP readout very closely today, looking for something at around that 7.3% mark. That'd be the lowest in 3 years. Is that where your estimates are at?
Yes.
Okay, you two are looking for 7.3.
What I read this morning was 7.3, 7.4, but and you said, and rightly so, that's been the lowest number in 3 years. But for some reason, the market is saying we believe that to be a trough. We believe that to be the low. Like, it's not going to go any lower than that. And all signs are pointing upwards. Now, we'll see a lot more of that with the flash PMIs coming out later on. However, the market, at least in the U.S., is seeming to think that 7.3, not a good number, but it's a bottom number. It's like that's as worse as it's going to get for China.
Okay, I want to ask then why this macro focus in the States all of a sudden. Why aren't you eyeing earnings season? It seems like as soon as it gets a little bit less exciting or a little bit shady, you look at the big macro picture.
Yeah, and that's a wonderful question. And I think it's only because we've walked down these numbers or these expectations so far in the past 3 months that right now that the expectations are so low, so any number that comes out that's better or equal to expected, nobody really cares. It seems like, again, we're just looking beyond that, expecting maybe a 105 top-down number for the S&P 500 collectively, but looking more at issues like China, the U.S. numbers, Europe's tail risk being removed. That's bigger than what the expectations for the earnings have been.
What about the fiscal cliff? That's got to be a big risk as well for markets at the moment. We've got the US presidential debates. We had one yesterday. The market must be focused on this as well.
You'd think that we'd be focused on the fiscal cliff, but Americans are just very unique in the sense that the way it looks now, the fiscal cliff would have a 4.5% impact on the GDP. That's horrible. I mean, that's a big game changer for our market. However, no one thinks that's going to happen. We think there's going to be a last-minute compromise at the end of the day to pay down some of the debt with some spending cuts and perhaps have a much smaller impact on GDP. So that's what the market's factoring in today.